I'm delighted to be joined by Kate Durian, Nice contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington, D.C. Victor Yan, senior editor of the JLC Network Technology, and Ed Bell, senior director of market economics at Emirates NBD here in Dubai. Thanks everybody for joining us this morning. Kate, let's start with the news overnight. Is it news? Is it not news? That's my question to you. Surprised that the EU came together on this agreement, a sixth round of sanctions, or not?
Well, I mean, it's been brewing for a while. Everybody expected that there would be some kind of a deal. And, you know, the agreement is that they will stop importing Russian oil by the end of the year, except for pipeline exports, which would affect Hungary, Czech Republic, and one other, I can't remember. But anyway, it came in late last night, and we've already seen the price sort of, you know, jerk up. So I think even though it was expected, it was probably factored into the market, it still has psychological effects. I mean, you know, you're talking about 2/3 of exports from Russia, and Russian production may not be may not have fallen as much as was expected in February. It still is, you know, sort of, it's uncertain how much Russian production and exports we're going to lose. Of course, some of it is going to Asia, a lot of it is going to China, India. So it's that uncertainty, I think, that's keeping a bottom on markets.
Okay, and I mean, in terms of the pipeline gas, which is exempted for the time being, and that, of course, a lot of that goes to Germany, Poland, large consumers. I mean, the shipped oil, sorry, not gas, is you know, Hungary, etc., are not huge players in the market. So, would we expect that even that pipeline gas may come under further limitations, or you know, if that's going to keep pumping, then really this has been factored into the market already?
Well, I mean, Germany is not going to be importing through the Druzhba pipeline, as far as I can tell from what's come out late last night. I mean, I'm a night owl, but I stayed up, I watched it, but it's still filtering out the exact details of it. So I think it's mainly that, you know, 3 countries that have exemptions. So it just remains to be seen what Russia's response is. You know, we've seen one of the heads of the oil companies say that they should actually reduce production in order to get higher prices. I mean, at the moment, Russia is also benefiting from the higher prices, global prices. So it remains to be seen how they respond to this latest decision.
Okay, Victor, good morning again. Let's go to you because, of course, China has been one of the sort of principal buyers of this discounted Russian oil in the last 2-3 months and continues to do so. You can give us an update on that. Apparently that discount is not so great anymore, not so attractive, but can Russia find and rely, let's say, on China as a consistent buyer for its oil now that it's losing more European buyers?
Yes, well, and we are now seeing a significant rebound in China's imports of Russian crude in May. And it will be more significant in the future when these discounts continue as well, because the pressure from high cost are just too high on Chinese refineries as well. Not just state-owned refineries, not just independent ones, but also state-owned ones are looking for cheaper grades. So when such cargoes or such grades is available with discounts, they will snatch up. And say Russian crude just accounted for about 15% of China's crude imports in the past. But this share could jump in the future, say to over 20%, 30%, and even higher next year if this trend continues. Yes.
Okay, and is China still buying? What kind of volumes do you expect it to continue buying as we end the second quarter? Give us an update on you know, there is some feeling that China is on the cusp of, you know, entering a bit more of a positive period now that it's sort of getting through its COVID troubles. What's the outlook there?
Well, the restriction is now kind of easing now, saying the government is trying to avoid lockdown. We are now taking nuclear exit test on a regular basis. Say in big cities like in Guangzhou, every 2 days, once every 2 days, or 3 days. And in smaller cities, probably 5 or 4 days once. So the government is now rolling out this policy to avoid further lockdown. So wherever you are, whether the city has reported new cases on a daily basis or not, you need to take tests on a regular basis. So the government can find out, the virus as early as possible and avoid lockdown. That's one of the strategies. Yes.
Okay, thanks. Ed, good morning again. Let's just look at a bigger picture scenario before we delve into what central banks may be planning and how that's going to impact economies. But overall, is the balance out there that we are expecting the global economy to decelerate with the action that's happening, etc. On the central bank front? What's the current mood? And there seems to be differing opinions out there that we will not see. I mean, we'll see deceleration, but we're not going to see recession, perhaps any time before end of 23, 24.
Yeah, I think there's pretty strong consensus that growth is going to be slowing this year for a couple of reasons. One is just a base effect. We had very strong post-pandemic recovery last year. So that kind of pace of growth we had, particularly in big developed economies, growing by more than 5% is not something that's going to be sustained. And then we have the inflationary impact of that resurgence of demand that central bankers are now having to fight against by raising interest rates. And so that's going to act as another kind of handbrake to growth this year, along with a lot of uncertainties about supply chains that drove inflation higher in the first place. Those really haven't de-escalated or dematerialized. And now you have the uncertainty about the outlook for global commodity prices. Obviously, here we talk a lot about high energy costs and what that means for global growth, what that means for the GCC region, but also global food prices being very elevated as well. So all of these things will be sucking away the ability for consumers to go out and spend. We've had some positive numbers coming out from countries like the United States where households are still quite flush from the pandemic and that they had a lot of cash was handed out to them. They're able to run those savings down, but that level of savings is coming off quite sharply. So if you look at, say, savings as a share of disposable income now, it's only about 4%. That compares with a pre-pandemic level of closer to 7%. So there's going to be a limit in terms of how much of those savings you can dip into to be able to support growth. So certainly it is going to set the scene for a slowdown and an activity this year. We don't see the odds of a recession, at least for the United States, materializing in 2022, but I think the risks are more acute for next year, particularly if the Federal Reserve does go full throttled in terms of their fight against inflation. And I think there's been a little bit of a pushback in markets lately, but sort of asking that they don't want the central bank to go as hard as they had basically egging them on to do. But all the commentary from the central bankers, barring one, has been, we're committed to tackling inflation. We don't care what happens to your financial portfolio, or even if it results in the unemployment rate going up a little bit. Inflation is the number one priority and then a more detriment to growth right now.
But do you think they'll still be cautious in terms of how they manage the basis point moves? I mean, the risk, they took a risk by not coming in sooner, and we've seen the impact of that. How much fear is there of them risking, making an error on the way down as well? I mean, and managing, obviously trying to go into recession clearly, and how tolerable an inflation rate could they actually accept possibly as things do start to calm down?
Yeah, I mean, it's a sort of living experiment that they're trying to figure out their way through right now. So I think for them, the risk is, okay, even if they say raise by 100 basis points over June and July, as is expected, and we get up to say 2 3/4 by the end of this year and a couple more next year, if all we do is get the rate of inflation to go from over 8% in the United States to say 4%, your gasoline price is still going to be $4 or $5 a barrel. What I think the central bank, and that's going to be an issue that consumers still have to endure. What the central banks probably want is prices to start going negative, and that's going to be a result of a recession in order to get inflation back closer to their target kind of level. So we're very far away from those circumstances being in place, and that's going to be very tight monetary policy standards that need to be introduced pretty much globally, not just the United States, but if you look at the inflation picture in the UK, for instance, very dire. We've had inflation data out from Germany, from several European countries yesterday. We'll get the full EU picture later today. Very elevated inflation pressures that the EU has never really had to experience during the time of the European Central Bank. So it's going to be difficult, I think, for them to just do a little bit and say, well, we raised enough to bring the rate of inflation from 8 to 4% or 8 to 3%. They actually need to get inflation coming negative, I think, in order for the kind of sustainable growth story to reemerge in a lot of these economies.
Okay. Kate, just back to oil and the sanctions on Russian oil and the tightness of the market. I mean, it's not just Russian oil that's getting tighter. The outlook for that. US production isn't really increasing much. We've had, OPEC pretty much assuming now, I don't know, you can tell us if I'm wrong, that they will do nothing before September. So given all that, how long will it take, this newly embargoed oil from now to the end of the year? How long do you think it'll really take to kick into the market, to take effect? It's not going to happen tomorrow. So will Europe actually stop buying as it has done immediately? How long will that take to trickle through?
I mean, it is, yes, obviously it's going to take time. It's not going to happen immediately, but I think, as I said earlier, I think it is factored into price. Some people are predicting that prices will go even higher, but it's such an uncertain time. You can't really tell where prices are heading, but you can see that the market is very bullish. It's feeding into inflationary pressures on everything. You have issues with fertilizer not being available, so that's going to affect crops. You've got the port of Odessa, so long as it remains closed, you're not going to get the grains out. So, there's such a combination of factors, and it's feeding into commodities across the board, not just oil. It's refined product, it's tight refineries. And I think we'll see, it'll be interesting to see the US numbers when they come out after the long weekend, the Memorial Day weekend, because, how many people actually took to the roads, how many people traveled. In the UK, people tried to leave, but they couldn't because there were staff shortages. So you had these long queues at airports, flights being cancelled, luggage being diverted from one airport to another. I mean, it's total chaos. So it's not a normal situation where you can actually say, okay, this is the direction that we see going. And of course, the OPEC Plus is ignoring calls. And if you listen to, some of the conversations in Davos, people were saying, guys, the market is not balanced. You keep saying it's balanced, but you look at the market structure. Yes, okay, maybe the backwardation is a bit tighter than it was earlier on, but the market is not balanced, and the market is telling you that it's not balanced. So you need to send a signal to the market that you're actually prepared to do something, because your own members are not producing. Russian production is down. It's not, it hasn't fallen off a cliff, but it is lower than it was. And yes, there are only 2 countries that can increase their production, but somehow they're sort of trying to hold this OPEC Plus alliance together seems to matter more than the impact that these high oil prices are having on the global economy.
That certainly seems to be the opinion that we're hearing. But I mean, given that we have a whole quarter, the third quarter, to get through until September, until OPEC's current deal expires, and given that in that quarter, regardless of sanction, of actual oil embargo in Russia, its production levels are predicted to go down because of other spare parts, technology, etc., that it can't get access to. So if what will it take? Some traders are predicting $150 oil in the next month. Will anything, do you think, trigger Saudi and the UAE to come in sooner than September?
I think for them, it's all about consensus and maintaining consensus. I mean, if I were Saudi Arabia or the UAE, which I'm not, I would say, okay, hang on a second, we're not trying to replace Russian oil. We are just trying to rebalance, the quotas, because some of our members are not producing. So if they would do at least that, then, but again, we go back to China and Chinese demand, what's happening in China? How soon is it going to open up? You've got ships waiting to offload. You've got, congestion at ports. I mean, it's too massive to say, this is where we're going. So I think it's going to take time to filter through. It depends on whether this EU, we've already had self-sanctioning. So you've got, Russian exports to Europe, seaborne exports have been down anyway. Gas is still flowing, so that's not going to come until the end of the year. And again, it's going to be a very tight market. So it's all building up.
Well, I mean, Victor, let's go to China again and ask you, yes, China has been importing for its SPR, and you were saying it's likely to continue doing so. Let's look at what the government's planning to do in terms of stimulating the economy in other ways, not just obviously certain sectors, the construction sector, service sectors, all those. Do you think we've seen the bottoming out? We've seen a lot of pressure on those sectors and some of them have collapsed. Where is the Chinese government at today in terms of its economic policy for the second half of the year and stimulating its economy?
Yes, well, for now, local governments are now rolling out a series of policies to stimulate their economic growth, say, including boosting the development of the real estate market. This is quite rare in the past 2 or 3 years, say, including making bank loans more accessible to people who want to buy houses, and reduce its restriction on the purchase of houses, So for small and medium enterprises, they cut taxes. And even for independent refiners, they postpone the levy of some tax. This is quite significant for them because they're under such heavy pressure from cost. And for some individual small household businesses, they spare some months of rent in districts where they have been hit by the violence. So a lot of measures were now being implemented to stimulate the growth of the economy.
What about the quotas for refineries? Are those going to be increased or eased anytime soon to encourage them to pump out more products? That's the tightest market, really, more than crude. China's exports are impacting not only its perhaps domestic economy, but also the region.
Well, China's refined products exports are actually declining this year, with only one exception, that's jet fuel exports. Because domestic demand is still so sluggish, but diesel demand, these exports has tumbled by about close to 90% so far this year. Say in the first 4 months, China exported only about 1.6 million metric tons of diesel, versus close to 9 million barrels, 9 million metric tons in the same month as last year. So you can calculate the change, close to 9 million metric tons last year in the first 4 months, and 1.6 million metric tons in the first 4 months of this year. And there's a great change in the domestic market. That's the consumption tax on LCO, which was a very important component for diesel blending. And LCO was actually directly used as diesel fuel in some cases in China. That was illegal too. So the Chinese government cracked down on such behavior, such activity last year. And now almost no such impact from LCO and diesel blending. So that's a huge boost to the domestic market. And so Chinese refiners, boosted their production sharply as from the last quarter of last year, after a severe shortage pop up in late September. And so until last month, they were still boosting diesel production quite significantly on a year-on-year basis. So we are actually seeing a very large decline in diesel exports this year. And gasoline exports will also drop, but not so sharply. So on the whole, we are seeing much less exports from China this year.
Yeah. Edward, just if we can go to the Middle East economies here, the Gulf economies, clearly let's look at our poll, which is addressing the question of oil prices and revenues that I was going to get onto with you now. now that we know the EU embargo looks likely, I think that's meant to be, now we know what it looks like, where will oil prices sit at the end of June, at the end of the second quarter? And there's your choices between 110 and below to 140 plus. Today, we're almost hitting 120. So in a month's time, how much of an increase are we going to see? So if we can get those results back in a few minutes from Irene. Ed, I mean, looking at those prices and obviously the very healthy revenues that the Gulf producers are getting as a result of that. But how concerned are they on the other front? And is that enough, let's say, that cushion to cushion them from the inflationary impact they are getting, being pegged to the dollar, the food price crisis that's hitting everybody? You know, is there any concern there, or are we very happy here because we're seeing, you know, 110 plus dollar?
Well, I think in terms of the fiscal position, we've had a remarkable turnaround in terms of balance sheets for all of the GCC producers. So for instance, in Saudi Arabia, we estimated that we had a deficit of around about 2% of GDP last year. This year, we're projecting a surplus of 10%. So that's quite an astonishing amount of cash that's going to be flowing into the economy, or at least flowing into the coffers, let's say. There are other issues in terms of how it's actually being distributed to the economy. We're not seeing the same kind of fiscal exuberance that we've had in past experiences when the oil price has gone quite high for the GCC economy. So sort of fiscal discipline seems to still be the mantra. Now, the GCC had, I think, for much of last year been somewhat of a global outlier in that we were not experiencing the same kind of inflationary pressures that many of the big developed economies had been. And we have started to see those trickle through now, whether it's in the form of higher retail fuel prices, which we're experiencing here in the UAE very acutely, or higher imported costs for essentially any finished product that's coming in, and also food costs as well. So we finally had Dubai CPI numbers. It's the first time they published for the whole year so far. Came out yesterday that showed CPI growth of 4.6% in Dubai for the April readings. So that's quite high, given that we've been in disinflation or deflationary territory for much of the past few years. So far, there doesn't seem to be any kind of policy response to high inflationary pressures in the region just yet, but we do stand probably better posed than we do in the last couple of years to be able to accommodate or offset them if the government did choose to enact some kind of price control measures, similar to what we saw during COVID, during the early days of COVID, when there were restrictions on, say, how much sort of wholesalers could increase things for basic commodities, the prices of food on a monthly basis. So those tools do exist. They have not been deployed just yet. You could see, say, limits on how high retail fuel prices go in places like Saudi Arabia or across the rest of the GCC. But I don't think we have, there's not quite the panic stations level of where inflation is at the moment in terms of those things being introduced, even though the cash is there, able to be deployed to do so.
Yeah, Kate, I mean, talking about inflation figures and back to Europe, obviously the ECB also is considering and has been playing with interest rates, basis points, but is it constrained really because of the war that's going on in Europe? I mean, what is the feeling in the UK and elsewhere in Europe, where they just don't have the privilege, let's say, of being as hawkish as the Fed may be because of these challenges with the war and what that's doing to the economy, putting oil aside. What's the mood there, particularly in the UK where you are?
Well, the mood is down. People are complaining about, you know, having to pay more in the supermarkets, not having, you know, enough disposable income. And I think it's, you know, some people argue and say, oh no, because, you know, we've had 2 years of disruption because of COVID. People are just dying to go out and spend. But, you know, that's the reality is that your disposable income is falling now. The government wants to give the people money so that they can cope with rising energy costs. But, you know, it's a few £100 per household. That's not going to be enough to temper. And I think, again, these are things that are just going to, they're being compounded. So I think we are going to see higher interest rates. We already have. It's going to affect the housing market. And I think it's, we're already seeing in China a slowdown in the housing market. So I think if you get a contraction in, a big economy like China, it's going to have an impact. I think the Gulf states, they obviously follow US interest rates closely because of the dollar peg, because of the way they. So I think it's inevitable that you have to slow inflation, and that's it's bad medicine, but it's necessary, I suppose.
Okay, look, there we've got the result of the poll. 130 is the majority. In a month's time, we could see prices up another $10, I guess, or so. No one has voted for below 110, which is sort of interesting. But we are only looking at a month ahead. Kate, just staying with you and just back to the Russian oil. Apart from China, what other, and India to an extent, although India supposedly is not buying too much of that Russian oil, does Russian oil have another home if these European buyers actually stop buying in the next couple of months? What other options does Russia have, and how much impact will that have?
I don't think very many options, frankly. I mean, if you look at the numbers of pipeline flows, they're much lower than seaborne crude, which is what's going to be impacted by the EU sanctions. So you've got about, I think, 1.9 million that's exported by that seaborne Russian exports to Europe, as opposed to less than 1 million, about 800,000 to via the Druzhba pipeline. So I think that's 1.9 million is quite a big number to sort of divert, and I think you're going to see more competition in the way that the Gulf states are pricing their oil, particularly to the Asian market. I mean, let's not forget that's our key market. Yes, we are seeing a bit of dislocation. You're seeing more some exports to the US to make up for the ban on Russian oil. And let's not forget, it's not just Russian oil, it's refined products as well that are going to be affected. You've got gas being phased down, natural gas, LNG. And you also have, and I think I saw it in an article that you had on yesterday's digest, the insurance ban. That's going to affect your ability. We've now got also tensions in over the seizure of these two Iranian tankers by Greece. It's not Iranian tankers, but Greek flag tankers carrying Iranian oil. So I think that is also adding to tensions in the market. So it's multiplying.
And the Iranian, while you've mentioned it, consensus again forming around the fact that we're not going to see a deal with Iran and the US before the midterms. Would you agree with that?
Yes, I mean, talk about cutting your nose to spite your face. You do something like this while you're negotiating a deal that's going nowhere. But there's a very interesting number, and I heard it by Fatih Birol in Davos, and he said, the oil industry is going to make this year estimated $4 trillion. As opposed to an average over the past 5 years of 1.5 trillion. And what are you going to do with that money? What are you going to do with that windfall? I think that's interesting. And I think we're going to see, these oil producing countries like Saudi Arabia, now $1 trillion economy. You're going to see a two-track economy. So you're going to see these oil producers actually, winning, and you're going to have the consuming nations and the importing nations that are going to suffer more. And they're the ones who are, really impacted by rising food prices, by higher import bills. So I think it's a really dangerous time to be looking at the global economy and this sort of this divergence. It's no longer you can no longer see the kind of growth that we've seen. If China goes into negative growth, then that's going to impact the global economy.
Yeah, and that's so, thank you, Kate. Let's go to Victor. We'll give you the last word, Victor, on that. And that was going to be my question. The last time we had you on the program, or the last couple of times, you've been saying that the GDP outlook by China itself for China is still around 5% or below 4.5%. Has that changed? Do you see that changing positively now that things are looking a bit more, that things are opening up perhaps the next quarter? Where's the latest thinking on that?
Well, we are now facing a lot of, maybe more uncertainties than ever now at this time. So, and say for the second quarter, it's actually under more downward pressure than previously expected. Say previously we expected kind of growth, say similar to the first quarter, in the second quarter, but now it seems impossible. Say for the second quarter, if the country's economy could grow at all, that would be already a great achievement. So for the whole year, it's probably well below the previous target of 5.5% of growth.
Okay, so what would that be? As you're saying, Q2 may not grow at all. What about the outlook for Q3 and Q4? You don't know, or what would you gamble would be the final average growth for the year?
Well, we expect the growth, the economy to rebound in the third and fourth quarter. And for the whole year, it might settle between something like 3 to 3.5% of growth, something like that. And as you know, we are seeing more uncertainties than before, so things could change quite quickly too. So yes, we see.
Okay, and Ed, just back to thank you, Victor, and thank you, Kate. Ed, last word, average growth GDP for the US this year.
Pardon me. It's still, likely to come in a little bit above 2%. I think there's still quite a lot of good momentum, particularly from the consumer side of the economy. But I think essentially the trend that we're going to see, not just in the US, but across many emerging market or many big economies, we've had the growth, right? It happened in Q1, and now it's going to start to fade out over the rest of the year. So when we start to look at the perhaps year-on-year numbers at the end of, or in Q4, things start to look a lot more ropey, maybe even a contraction. You already had the Bank of England projecting that things are going to decline on an annual basis, not necessarily a recession by the conventional definition, but that you're going to have a smaller economy in the foreseeable future.
Okay, thank you. And meanwhile, here in the GCC, we're continuing to see the numbers possibly go up as an exception. Thanks very much to Ed Bell, Victor Yang, and Kate Durian. Thank you for joining us all this morning, and have a great remainder of the week.
Thank you.
You too. Thank you.